All right, well, I might kick off then. Thanks everyone for joining us today. First of all, on behalf of those present, I'd like to acknowledge the Gadigal of the Eora Nation as the traditional custodians of this land I'm presenting on and pay my respects to elders both past, present and future. For those of you I haven't met, my name's Amanda Price. I'm the Head of High Growth Ventures. High Growth Ventures is a team 100% focused on working with startups with a range of products and programs specifically designed and priced to support startups from Series A and beyond. So our Q&A topic for today is, how should founders prepare for the decline in startup valuations and investor interest? And the people that are going to discuss this with us today are Sarah Hunter, who is having computer problems. She's a partner, senior economist at KPMG. Dan Teper. Dan is a partner at KPMG in M&A and also head of Fintech. And there's a man who needs no introduction, which is Martin Dalglish, arguably one of Australia's most experienced VCs. He is a partner in Heal Partners and also a partner in his new fund, which is Real VC. Just a little bit of housekeeping as well. I just have got to say that the session is being recorded. If you don't wish to be part of the recording, just let us know in the chat. All right, so I think we'll kick off with you, Sarah, actually, and just sort of set a bit of context around the downturn. So I read in your CV, it says, Sarah brings significant experience forecasting and analysing cyclical shifts and structural developments in the Australian and global economies. And that means to me that you are the right person to talk about the downturn and give us sort of your views on sort of the outlook.
Yeah, well, I've been looking at the Australian and world economy for a long time, and I have to say that right now is possibly the most interesting point in my career in terms of what's happening and trying to sift through it and work out how the other side might look. I have to say, the economists at times it does feel like we're staring into a crystal ball. So I'll put the usual health warnings around anything that I say. It's not always easy knowing what's going on, but at the moment I think there's a few sort of factors that are playing through, particularly if I'm thinking about a sort of investor VC capital market space. We're obviously coming through, and this is globally, not just in Australia, the pandemic goes without saying, but the recovery from that, very, very robust, lots of fiscal and monetary support for that, that's really played through the system. And so the world economy has had a really strong 12 months. Australia, obviously a little bit later than that, given our Delta lockdowns last year, but certainly the last 6 months have been incredibly strong economic performance, and that's generated these inflationary pressures. I think what's really important to keep in mind for right now is that some of the inflation we're seeing is absolutely coming from supply side shocks, particularly what's happening in Ukraine, also some what's happening in China around lockdowns there and supply chain disruptions. But a good chunk of it is actually demand driven. It's fiscal and monetary policy driven. The levers worked. They took us out of the pandemic downturn and into recovery, but arguably with hindsight they overshot. So looking at that and setting that context, it's clear why central banks, I think, are now raising rates really very aggressively. But this then is obviously creating some disruption in financial markets. Where are rates going to, and how do we sort of get valuations back, and when is the right time to jump in if we hit the bottom or not? I can't tell you that I've got definite answers to all of these things, but from what I can see, interest rates globally, certainly in Australia, they've got further to go, but I would say that we're probably well over the halfway point in terms of coming up from that base. Certainly here in Australia, obviously we had the cash rate rise yesterday to 2.35%. I certainly don't expect the RBA to be going north of 4.5%, not even north of 4%. So we're clearly over halfway, and I think that's generally true for a number of central banks actually. So that monetary tightening cycle has been very short, very sharp. It'll keep being that, but I think by the time we get it not long into next year, we'll have hit the peak in rates, and central banks will have done enough, and they'll be at the very least pausing to see what happens. With that in mind, then, have we hit the bottom in terms of valuations, and what does that type of activity look like? Well, here, sadly, I'm going to sit on the fence, as all good economists do from time to time, and say maybe. I think in some sectors, some parts of the economy, yes, there's always opportunity, challenge for sure, but there's always opportunity. But in others, perhaps we haven't fully played through and worked through what their long-term trajectory might look like, particularly given post-COVID shifts. And I have some questions around working patterns and any business that's related to that sort of office environment. I also have some questions around the recovery in tourism and what that might look like, particularly given the sort of step change that we've seen in fuel prices and travel costs more broadly. So maybe is the answer, but at least for interest rates, I think that there is some light at the end of the tunnel, but we're not at that entrance just yet.
Yeah, just you touched on some of the industries before. I mean, if we just sort of look at that a little bit more specifically, do you see any industries that are more impacted than others, or conversely, any other industries that you think are being more resilient?
Yeah, I think it's been really interesting, somewhat ironic, given my laptop IT problems this morning. I think that tech was one of those sectors that was obviously very, very popular through the pandemic and really overshot the most, and then certainly has come back down in terms of its valuations. But as a long-term player, I still think it's absolutely one of the places you would want to be looking, and it's probably going in different directions now. Cyber and cybersecurity, for instance, I think is going to be really important. Stuff that's related to defence, in particular, is absolutely going to be a strong growth for me looking forward through the next 5 years or so. We know that from government commitments around defence spending, if nothing else. And a word to that, they've committed to 2% of GDP. Actually, if you talk to people in the sector, they'll tell you to deliver everything, it's going to be more like 3% of GDP. That's a huge step change up, and it's not just in Australia, it's around the world. So that's certainly one aspect that I would see some really strong growth in. And the other really interesting is health and aged and personal care. So one thing I was looking at when we got the census data, big moment for me as an economist, we only get it every 5 years, was looking at the distribution of the population and just thinking about what that looks like over the next 5-10 years. And there's over 20%, 21% of our population are the baby boomers. Their average age right now is 65. So if I'm thinking about services that they want to consume that will help them stay in their homes, that's a trend we can also see. It's a lot that's around those supports personal services, if you like. I'm sure we'll come up with a good name for that particular sector, but it's everything from someone who does the gardening right through to in-home nursing and everything in between. So that for me is another really strong driver, and that is a really big glut of people that are just entering that phase of their life. So those were the two that I would flag, I think.
Right. I've just got a question too from Tim Warren. Sarah, you mentioned that inflation is primarily demand driven. Do you have a split between demand drivers compared to the supply shocks and the impact on inflation? Why does the RBA not appear to be taking this into account, the supply side, in the decision making?
Yeah, no, it's a good question. I'm not sure. I'm not sure it's primarily. I mean, actually, it was interesting. I've seen some analysis for the US that comes out with it being not far off 50-50 actually, but that's for the US economy. So for us, I suppose here, the supply is probably a bit more dominant because our demand pressures are a little less pronounced, and we can see that in the wages data, for instance. But demand is an important component of it, and I suppose the counterfactual, if we'd had no supply shocks, would we still be in a rate tightening cycle right now? I think the answer to that is yes. It just perhaps wouldn't be as aggressive as what we're currently seeing. In terms of are the RBA factoring that into their decision, it's a really tough one for them. I think, in hindsight, they should have gone sooner. That would have meant that they could be more gradual. But at the same time, they do need to respond, and they do need to move quickly now. And I think for them, part of their job, part of the challenge of their job is the communications, actually. And for a long time, they were saying to us, it's supply shocks, we can't do much about those. Transitory inflation, that word is going to haunt central bankers, I suspect, for a long time to come. That communication and then the pivot in policy, they did need to take a step change. So I don't think inside the RBA that they've forgotten the supply side role, and they're certainly not forgetting it in their forecasts either. They do have inflation coming down, but I think right now they're really trying to communicate the need for tightening, and that necessitates a focus on demand, and that I think is really coming through very strongly in their statements at the moment.
Excellent, thank you. And I was actually meant to say before too, please, if you've got questions, put them in the chat because I'll keep an eye on that. Martin, just to go to you, as an experienced investor who has experienced a downturn or two, how does this one feel to you? Does it does this feel the same, different?
I think you very politely just called me old, Amanda. Well done, you snuck that one in. Yeah, I've seen a few cycles over the years, and does this one feel any different? Not at this stage, to be honest. I mean, the circumstances that we're in, as Sarah just very well articulated, are different. And I think the uncertainty coming out of this is a lot more questionable or different, I could characterize. That said, 30, 40 years of doing this, it is a cyclical business. We do see interest rate increases, interest rate decreases, inflationary pressures, deflationary pressures, and bad luck for all of us. We have to live through that, right? So, early stage companies shouldn't be too set on the macroeconomic conditions. I mean, certainly later stage growth companies are. And Sarah made a point there I just wanted to kind of touch on, actually, Amanda, around, tech companies are probably more profoundly impacted on the valuation front. And there's a very simple reason for that, of course, is that high growth companies, obviously, on a classic sort of DCF analysis, the discount rates, because of a high inflationary and high interest rate environment, are higher and they compound, and therefore valuations on an objective test come down. Early seed companies, early startups don't typically get valued on those sort of parameters, right? You can't really run a DCF on a seed company that doesn't have much revenue. So, as a very good colleague of mine says, all models are interesting, but they're all wrong, So I think we are living in slightly untested waters, but, sure as the sun will come up tomorrow, this cycle will change at some point.
Yeah. And how does, we've sort of thinking about this downturn, how it impacts investor behaviour. We saw, I don't know if you read there was the leaked investor sort of update from Square Peg that said they'd written down the valuation of funds 1, 2 and 3. And I think in that they were talking about that in one of the letters we saw, they were saying that they were really to slow down their investment, the rate of investment, which is really then that I think on Twitter, Nikki Shabat from Blackbird went back and said, no, we should maintain a cadence. How does the downturn impact the behaviours? And is a slow, will we see a slowdown from investors?
Look, there's definitely a slowdown in cadence. I don't think there's any doubt about that. And there's sort of different market data coming through now that's sort of demonstrating that. That said, they're all proxies, right? I mean, all the various reports on what the value of venture spend in any particular quarter is an estimate at best, because a lot of it is done quietly. And I think you'll find that there's probably a lot of bridge rounds at the moment, so a lot of kind of relatively flat insider-led rounds to continue to shore up balance sheets, and they don't necessarily get reported through to the AFR or any economist who's measuring venture spend in Australia in any particular quarter. So keep that in mind. It's a bit of a proxy, but I think that data does show that there's a slowdown in cadence. I think I can speak to a number of VCs that I'm close to, including my own, of course, is that we are being cautious about deploying capital for a while, whilst we kind of wait to see where the equilibrium lands, right? So deals are getting done, so it's not zero, but there's certainly a caution. I think we're seeing a retracing of valuations back to probably circa 5-ish years ago, particularly at the seed level. So, to that extent, there's a slowdown. The other point to make, though, I think, is that ultimately there is a lot of the term dry powder gets mentioned. I'm sure everyone on this call is familiar with that. The amount of capital that is committed into venture is as strong as it's ever been in Australia, and managers fundamentally don't get paid unless they're investing that capital, right? So there's a sort of there's a push and pull here, right? There's a degree to which ultimately that capital will be deployed, but it will be deployed cautiously, perhaps more selectively, and certainly at lower valuations. And someone just asked a question there, what was that term? Dry powder is the term. So it's the amount of capital that venture funds have committed, but they haven't deployed yet.
Yeah. I suppose we're hearing, everyone's reading that companies really, where it came out for me, we went to Venture Down Under, the Innovation Day conference where a lot of the VCs go. And it was the first time in 4 years that we were really starting to hear the message change from growth to we want capital efficient companies, operation, all of it. And so it sort of seems that it's going to have a bit of an impact on the type of companies that they're going to go after, that you're going to invest in as well. Do you think that, how's that going to shift?
Yeah, I'm not sure I agree with that, to be honest. So different funds have different thesis, right? So there are early stage funds, there are later stage funds, and they specialize in that in their particular kind of respective playing fields, right? So now, we have seen, particularly in the last 3-4 years, a lot of the big US growth equity guys come into Australia. And the reasons they are doing that is because every decent deal in the US is very highly contested. Typically it's sort of a term sheet battle. So they've all kind of come into Australia, guns blazing, and they've been deploying capital at a hell of a rate. And So I think we'll see that slow down. But, look, seed investors will still look to do seed deals. Series A investors will still look to do Series A deals. So I don't think there's any sort of fundamental shift on that. That said, back to my earlier point, about selectivity, and you just mentioned the word capital efficiency, which is interesting there too, right? So, we are looking, particularly in the sort of the later stage deals where, there is proven revenue traction, there's a sort of a burn rate that you can get your mind around. One of the things that we like to measure, particularly SaaS companies, is what we call the capital efficiency ratio, which is the amount of capital you're burning relative to the growth in your revenue. And that's something which, in days like this tend to become a bit more focused, where it's not just about funding cash incinerators, right? We're not throwing money at projects that just grow customer bases for the sake of growing customer bases and hope that the profitability will come through. So we look at unit economics, we look at capital efficiency, and that's more heightened right now, right? And that's good. That's a good discipline. And often that discipline disappears in the heady days, right? Because there's a bit of a FOMO thing. Everyone's sort of rushing to get the deal and they're worried about missing out and, the next Canva or whatever it might be, right? So I think we're just seeing a kind of return to discipline and a return to some of those key metrics. And I think that's generally very positive because that keeps all of us on our toes.
Yeah, and I think we're certainly seeing that in terms of some of the support that we're asking, the founders are asking us to provide, which is, I think the message they're getting from some of the VCs is really get your house in order, making sure that it's being run, effectively. And I suppose it's a real focus on extending that cash run, the amount of cash that you have, or minimizing cash burn.
For sure, there's a great phrase that I love, which is break-even optionality, which is make sure you've got sufficient balance sheet where you can. This is more for sort of mid to later stage companies, by the way, that you've got sufficient balance sheet strength to be able to get to break even, right? So act on the basis that there may be no more capital coming. That's a pretty prudent basis to act on. So tighten up all round. And if you can get to break-even optionality, you'll be very well positioned for inevitably when the capital starts to flow a bit more again, right? So I think that's prudent advice in this sort of environment. Not everyone can do that. Early seed type deals where they're still trying to find product market fit, they would struggle on break-even optionality. But certainly the days of sort of flooding companies with capital early and then letting them kind of, acquire customers at a proverbial rate of knots and really not have any focus on profitability measures and that old adage about, we'll figure that out later, maybe not, and I recognize that's a cycle thing, right? Again, so because 2 years ago there were plenty of companies like that were being well funded.
Yeah, I suppose just to get a bit pointy on that, the question we're asked all the time is, especially obviously for companies that haven't raised yet, who need to go out and raising, what do I need to look like? What do I actually need to look like? How sort of, I suppose, what's actually changed for them in terms of what they'd be presenting to you and the metrics they'll use? Has any of that shifted?
Oh, I think, that's a good question. And I think certainly at the seed level, I think we look for the same things that we look for before, but there's probably a little bit more focus on revenue attainment. So if there's one lever that probably is more important today than it was a year ago, is what's the path to revenue and how does that look like? What does that look like, I should say? And, can that be done cost efficiently at an acquisition level? So, we still look at the same metrics that we've always looked at. We look at the management, we look at the market, we look at the model, we call it the moat. This is my 5M model that I'm now professing here, the moat or the competitive advantage. And we look at the moment, is this the right time? So the model's the interesting one though, because model, at a very early stage company, it's sometimes a little bit unproven, but, we just really want to be sure that there's a clear understanding of revenue attainment, that there's some demonstration of product market fit. So certainly emphasizing that, and then probably being a little bit more cautious in deployment of capital and being very milestone driven. We'll come to valuations and dilution later, no doubt, in this conversation, but ensuring that you've got a really clear understanding of what you're looking to attain in any funding round and what you'll be measured against and what will set you up for the next funding round is quite critical. So be very milestone focused.
Yeah, that's great. And a lot of our companies, obviously most of them actually are looking at expanding overseas at some point. And Sarah, I was listening to one of your talks a couple of weeks ago, I think it was, and you were talking about the economic conditions in the US and the UK being more severe than what we're likely to experience. Can you sort of touch on that? And if I'm a founder here thinking I'm going to go to the US, do I wait? Do I go? How does it impact my sort of planning?
Yeah, I mean, and you're absolutely right. Conditions, particularly in Europe, so the UK, but Europe more broadly, very, very challenging right now. And that's really a story around the situation with Ukraine, Russia, and energy markets there. And that's a region where they are effectively going to go into a recession in the not too distant future. And it'll look different in different countries. Some are more exposed than others. Germany, for instance, particularly exposed. The UK as well, particularly challenged, has Brexit and the transition from Brexit on top of everything else going on. But no, more broadly, yes, international markets are quite challenged at the moment. The US, it looks like rates are going to be going higher. So I suppose both from a funding perspective, that's more challenging, but also from an economic environment and trying to break into that market, it's a bit more challenging in the near term. I think the region I find quite interesting at the moment, and it is on our back door, is Asia. The situation in China is definitely difficult, not just from a COVID lockdown, manufacturing supply chain perspective. Actually, good news on that front. They're learning to live with COVID, as we all did. Still in a COVID zero environment, they still have the moment. I think it's 68 cities under lockdown, big and small. It's an incredible number of people that we don't really hear about that are still having to live with that. But their manufacturers are actually learning to adapt, which is very helpful for the supply chains. But the domestic market there is also quite challenging. But across Asia more broadly, actually, it's still some very strong growth dynamics in countries that we know about, but are really quite large and are the growing markets and potentially markets to go into. Singapore's performing very well. Vietnam, Indonesia, Malaysia has had a really strong start to the year, which is kind of fascinating to me. So Asia as a region still looks fundamentally very good. It's becoming very much middle income, certain countries across the region, and the dynamics are still pretty favorable. So I think in terms of looking overseas, the traditional markets have got a challenging couple of years ahead, no doubt, but there are potentially some opportunities elsewhere that might even be a bit closer to home.
Excellent, thank you. Just a couple of questions. So Teper, Martin, really great point, early stage companies who should not be as impacted by macro factors. How are investors looking at these at the moment though, investment appetite, etc.? Do we touch on that for later stage?
In terms of macro factors, look, I think, later stage, a lot of it, again, comes down to particularly later stage companies where you will model out what you think the company profile will look like and what your exit horizon looks like. So, yeah, you do take into consideration macro factors at very late stage investing. One of the things that I'm a partner in a late stage growth equity fund, and, we do model out what our exit scenarios and exit horizons are, and we will probably use exit multiples that are more compressed than what they were a year ago, right? So that's a direct kind of reflection on macroeconomic conditions where we just assume that multiples and valuations will be compressed for a period of time. And then you model out what your expected return is and whether it fits the fund mandate. So yeah, so to some degree, later stage, yes. Early stage, though, really doesn't come too much into consideration in the investment decision. Apart from just making sure that you feel that the market is, back to my 5 M's that I talked about earlier on, is you've got to be comfortable that there's a very large addressable market and serviceable market opportunity. So, if it's demand driven and we think there's the demand is a bit benign in a particular opportunity, then that obviously affects your view.
Just one more question. I think this is asked a couple of times. So if a startup has invested their own capital to get to seed round, but a pre-revenue, are Australian VCs an option, or should they be aiming for angels, high net worths?
It's increasingly an option. There are some seed investors out there, and my new fund, Real VC, that we announced last week is a seed investor. So we will look for those sort of opportunities. More commonly, the larger VCs in Australia are more focused on larger growth rounds. Blackbird do a lot of seed deals, and I think they put some data out there. It's all on their website on the quantum of seed deals. Finding lead investors that are convicted and can lean in on seed deals is a little harder because venture tends to be more focused on the larger deal opportunities. Angel investors are good, and family offices and high net wealth type investors are good if they have some alignment and can add value. Passive investors generally early, you prefer to have lean in strategic investors than passive where you can, but you can get those from both angels, high net wealth. You could do equity crowdfunding, which I think is going to struggle a little bit in the current cycle. for that reason. I might be wrong, but venture tends to be more, Australian venture tends to be a little bit more late stage, apart from some of the earlier funds like Real VC and OIF Tidal Ventures. There's a few out there much more focused on seed.
Yeah, right click. Yep. And this one's actually interesting, just around, it's a question around the status and future of social impact investing. Can you touch on that, Martin, in terms of, I don't know if that question relates to whether those sort of, like we're seeing, I was looking at the cut through venture numbers yesterday, they're showing that, you know, climate tech and all these sort of things that you could lump into that impact in a lot of ways, sort of bucket, the investment had really increased. So I'm just interested in your thoughts on that as well.
Yeah, actually, I'll say a few words there, and I think that might be a good question for Dan, actually. So, so look, I mean, there are specialist impact investing funds, not so much in Australia, but certainly evolving and not early. So, but certainly in the US, I mean, you could pretty well bifurcate any category and there'd be a fund that specializes in that, right? So, in that context, I think most funds now have an impact lens. We certainly do. So, you know, from the perspective that, you know, we will only invest in opportunities that have some purpose, and purpose and impact, you know, can be intermingled, I think, a little bit here. And so that tends to, and, you know, we are seeing climate tech, ag tech, and other verticals, for want of a better word, that, you know, clearly are, you know, societally beneficial. But we haven't really seen impact investing as a sort of discrete fund category here yet, but I think that's something that will evolve. But, you know, I'll open to maybe to Dan to that he might have a broader perspective.
Yeah, I think what we're seeing locally, and thanks for that, Martin. What we're seeing locally is most funds, whether it be VCs or even kind of more mature private equity, when they go to the investment committee, they are now being asked around kind of what is the purpose of this business, kind of does it tick an ESG box, and where does that work through? And that's partly being led by the fund itself and making sure when they're thinking about the macro trends that the business is still going to be on trend when they look to exit. It's also a big requirement, though, for some of their LPs and actually investors into the fund themselves, who are saying, okay, we don't want to be associated with things which aren't ticking that box. But that's been around for quite a while now, and there's kind of very definitive funds who won't invest into certain industries, whether it be gambling or tobacco or alcohol and those type of things. What we are seeing, just the prominence of that is stepping up. I do feel at the moment, certainly, it is just a bit of a tick box, and you can always find some ESG angle with most investments or businesses. But we are definitely seeing the sentiment in that change, and that's partly being driven by kind of the underlying investors and as I say, the LPs, and I suspect they'll start being led again by the startups and the businesses that they're seeing in the market being more purpose-led in that regard.
And just to add to that, I mean, a broader trend that you can definitely see coming through is the need to be credible and quality, and, you know, greenwashing. And I don't think anyone's got an equivalent on the social side yet, but no, social washing, I'm not sure it's going to be that. Very, very tangible now, and you can see it in other countries that are leading the way in terms of identifying this and calling it out. So you need to be doing it to your point, Dan. It goes sort of beyond a box ticking exercise into something that has to be there and can be seen and can be measured and quantified. And that's a trend I think that will definitely continue if we just look overseas and how far they are. And Australia's running now and catching up rapidly.
All right, we might just move to the other half of the conversation now and give Dan his time to shine. All around valuations. Dan, just to sort of start broadly, like, how should founders be thinking about valuations in the current climate?
Yeah, sure. Look, I think the first thing I would kind of just reiterate, and this is back to Martin's point, is like people shouldn't be panicking or anything like that. Like, there is plenty of money out in the marketplace. What we're seeing, though, is that there's a shift in sentiment, and it's probably moved from what was a seller's market 12 months ago to more of a buyer's market, and there's a bit more of kind of a focus on the investors holding the keys and how they kind of approach kind of, we've got the capital and you want it, and that's how we play that out. So what that means is that kind of the basis for valuation doesn't change. You still need to kind of go out and be very clear about what are we trying to achieve, what is our revenue model, what does our cost model look like, when do we get to break even, all of the fundamentals of a typical business and how that plays out. What is different, though, is the process. Okay, so we're finding at the moment that as Martin mentioned earlier, people are more cautious, and we're currently in this kind of state of flux where everyone's kind of waiting to see, is the market got more to go, or does it turn, and where does that play out? We've obviously got a higher cost of capital because of inflationary pressures. Interest rates are going out, so people are saying, well, the opportunity cost of me putting my money here versus somewhere else has gone up, and sentiment is clearly not where it was kind of a year or 2 years ago. So what does that mean? It means that kind of processes are taking longer. So parties should kind of be extending out and making sure that they've got enough runway to get that done. We are probably having to speak to more parties. Parties want a deeper understanding. But then when you actually come to what does the valuation look like, then there's a question on, well, do you go to market with this is what we want to raise money at a valuation, or do you let the market inform you, right? Now, 12 months ago, I can tell you every time I was advising one of my clients before we went to market on the valuation, I would say, here's a range, it's X to Y. They would always pick Y. It was always the top end. We'd go to market and we'd get it away, right? The market was kind of extremely active, and as Martin mentioned previously, there's a bit of FOMO out there, and you're typically finding kind of very high valuations, but those high valuations being met. In the current environment, that is a little bit more uncertain, right? And what you don't want to do is go to market with the price which then doesn't ever get met and you have a failed round, because then you start to become very heavily a price taker rather than a price maker. So some of the ways that we're advising or we're working with our clients around this is we're going and not necessarily going with the price. We might indicate where we think value lies, but we actually let the market determine where that sits. And that is kind of being put out into reasonably good effect, because you let the market kind of price you and you get some feedback. We're also kind of saying where people have got a very firm view on valuation, people probably need to, and founders need to be a little bit more flexible, possibly on terms, possibly on structure, possibly on product. Do we give kind of downside protections for the investors? Is there different models where, for example, the valuation is low, but the founders kind of get options to take back equity or increase value as the performance kind of goes a certain way? So that's kind of a mishmash argument. There's no perfect way to kind of determine this. You ultimately need to, what you need to do is set a valuation or process which is ultimately going to give you success and get the funds in at a valuation that you're comfortable with. The key focus from us when we're doing it is making sure you've got sufficient runway and timelines to be able to kind of meet that process, and also making sure that you're not being too aggressive on valuation or being too stuck in your valuation whereby the market doesn't meet and then you kind of got a failed process or not being able to kind of get the money in at all.
There was when we got the question through, there were two questions that kept getting asked. So one was, what key principles do founders need to keep in mind for a valuation that can stand scrutiny?
Yep.
So okay. Do that one. I'll give you the next one after. Sorry.
Okay. So the first key principle is people need to. I think more than ever, people actually need to have a practical business and something which can make money and can move to essentially break even and self-funding in a reasonable time frame. There's all this kind of infamous talk of Massa-san saying, oh, we take a 100-year approach to valuation and we don't mind if the businesses don't make money. The market has moved, I think, away from that. Of course, there will still be those opportunities, but whereas a year ago people were maybe taking a 5 or a 10-year approach there, they're probably now taking a 3 or a 7-year approach, right? And what that means is that you need to be very clear around, okay, what is our route to market? What is our product? What is our innovation? Where does that sit? What does the addressable market look like? Can we break into that? How does that play out? And then, okay, and how do we price that? How do we then get the cost in? How do we run a business around that and work through that? In my mind, that's not different to what it was 12 months ago. I think the same fundamentals sit in terms of you need to be able to prove that. It's just people are being more cautious and therefore saying, oh, I want to see that sooner. I want to be able to kind of have better level of comfort that you're going to get to that level of profitability or that level of break even at probably an earlier time frame. Martin, I don't know if you got any thoughts on this. You're obviously seeing this from an investor perspective as well.
Yeah. There's valuations and art and science, right? So and at any point in the cycle, we go more art and more science, and it just depends on circumstance. The science side of it, DCF, comparable transactions, etc., precedent transactions, previous rounds, all of that comes into play. Obviously, you know, as we sort of work our way through the cycle, the sort of precedent transaction and comp transactions starts to become more evident. So, you know, that tends to kind of drive down as we see multiple compression. I mean, listed markets are always the kind of go-to for that, and we all know what's gone on there in the tech world. But, you know, to the extent that, and it's probably back to my key point around valuations, you know, people look for just really clear understanding of milestones, business plan, business model, ability to cost effectively acquire customers, as the case may be, and then drive margins. So, you know, those fundamentals don't go away, and you know, good investors will interrogate that quite deeply, and you have to be in a good position to be able to articulate strength around all of those parameters.
And I think the important thing you say there, Martin, is previously people weren't investigating it that deeply, I think, in some cases, especially where there was an existing cornerstone. There was people blindly following money because there was a lot of it about it was cheap, kind of where else did you put it? You had to spend it. The market has changed that, right? The opportunity cost is higher. Even if there's someone who's going in as a cornerstone, I still think that kind of follow-on investors are probably also doing more homework than they did do previously. And as a result of it, the pitch needs to be all that more articulate, the story needs to be all that more credible, and the numbers need to be all that more kind of due diligenceable to get people across the line in that regard.
Yeah, and we've got a question around the, you know, how detrimental is a down round, and that's, you know, we're speaking to a lot of founders now who, you know, want to raise capital, need to raise capital, but they're very hesitant to take this sort of lower valuation. Can you share, Dan, if you start, I'd be keen to get your thoughts on that.
So I think there's a couple of things at play here. Taking egos out of the room for a second, because I think that does play quite a big part when you talk about kind of the principle of a down round. I think investors and most of investors around the marketplace are cognizant in terms of what's going on, right? And therefore, if a down round means that a business can survive and can continue to thrive and prosper, I think existing shareholders, whether that be founders or angel investor series A, wherever you might be in your journey, will recognize that the market isn't today where it was previously, right? And if the down round is so extreme, then those investors should be doubling down if they believe that the valuation has kind of moved too far, and that's what they will do. So the first thing I'd say is it's not great from a visual perspective, but I think that's more to do with ego and to do with kind of articulation to your existing shareholder set, as opposed to like investors kind of genuinely saying that doesn't feel fair or doesn't feel appropriate. I think the other thing to note is the market has moved. Look at the listed comms, look at the transactions, look at everything in every piece of data. The market is not where it was 12 months ago. It just isn't, right? And therefore, I think people are grown up enough and sophisticated enough to recognize that. I don't think it necessarily means that, oh, this is a downward spiral and a downward trend, and therefore people can kind of survive that. However, that is more a market-led valuation as opposed to necessarily a business-led valuation. So if businesses haven't been able to hit the milestones that they've set, if businesses haven't been able to monetize or to expand or to grow, that's where I think down rounds start to be seen as more detrimental, because it's a function more of the business and its performance as opposed to the market and the environment and where we sit. Yeah, it's a hard one to kind of clearly articulate, I think. So
yeah.
If I may chime in there too, Amanda, you know, down rounds happen all the time. We just don't read about them, right? Because people don't PR their down rounds. So the AFR doesn't write a big story about so-and-so is just a big down round. So they happen, and they're not necessarily all bad, right? And now there are impacts on down rounds, and one of the key impacts is to founders and key management and staff who hold options that may be priced out of the money on a down round. So, you know, consideration of investors on down rounds when they do happen, and it's just a reflection of executional market conditions at the time, is, well, do we have sufficient skin in the game to the founders, sufficient skin in the game and motivation and incentive to the key management and staff who are probably being paid below market in early stage companies to participate. So, you know, levering down rounds against ESOPs and ESOP structures is important, because you've got to get that equilibrium, right? There's no value in crunching founders to a point where the founders are demotivated and disincentivized to grow the company. That's a path to zero, right? So these things all come into play. It happens all the time. Dan's right. It's emotional, right? Emotional for founders, because it's kind of like, yeah, hang on, my baby, I was on this trajectory and now I'm not. But you can recover, right? If you can execute on the fundamentals and the direction, and you know, there's a lot of, you know, there's a bit of serendipity in early stage companies too, right? You know, the best management team with the best model and the best market, sometimes just things don't quite go quite right. And that's maybe just a short-term aberration, right? But, you know, we always back good teams to kind of figure it out. And learn and be robust and resilient. And, so that's all part of the cycle, actually. So I'm, whilst investors are typically, depending on, if you've got preemptive rights and you can double down and you've got capacity to double down and avoid any dilution, that's important. Down rounds are sort of inevitable part of this whole system that we're in.
One of the questions, Dan, said it would be great to hear what valuation models work best with pre-seed stage startups.
The best valuation model there is get the money in, and as Mark said, finger in the air. Look, the model there, so previously you would look at kind of comps and see where others had raised money and kind of try and tag yourself to that. The challenge with that is the market's moved, and that's not always that appropriate now. At a level, it's kind of a bit of as Martin previously mentioned, it's the art, like what can you get away with justifying and what will someone pay you for it, right? What we've seen is that different models again have worked. So a good example, Judo Bank, right? Very successful. They've kind of went through the whole process of raising money, and then they've IPO'd. But when they actually took money on early on in their journey, and they got a number of institutional investors on, their valuation was only marginally higher than the actual cash that they were raising. And the reason for that is they had options in place for the management team, which meant that as they performed, they were effectively catching back or dragging back part of the equity back to them. And they've then enacted on their strategy, and that's been extremely effective for them, both in terms of their personal wealth, but then also for shareholders, because they're saying, well, we're clearly aligned, right? Like, we're putting the money in, we're funding you, and we're working through that. The different models that can come in play, as I mentioned previously, kind of 12 months ago, it was very much, this is the valuation we want to raise it at, and you kind of try your luck and you see if you get it away, and you probably were getting it away. I think in the current market, I think the model is let the market inform you and try and run something which is quasi-competitive, and you can have a few people or hopefully a few investors kind of vying for you and coming after you. And again, you can use precedents to kind of inform you or give you a view. The challenge is that those precedents are moving so quickly at the moment, and they're probably moving negatively right now. So it's hard to kind of keep up with where it sits. Martin, you obviously kind of within real, that's a key area and focus for you. So is it like sometimes I feel it's just what you can get away with, and it's a bit of a balancing act, right?
Pre-seed is really the hardest because there's not a lot you can really compare it to, right? So how do you value that? So there's sort of a broad market parameter around pre-seed deals. If you've got the right team with the right market opportunity, with the right expression of model, and some sort of early POC or proof of concept, or validation that there's a market opportunity here that can be prosecuted, then that helps. Right now, actually, I saw some pitch book data come through for Q2 the other day. This is US data. Seed level deals in the US sort of in the range of 5 to 10 million US as a median. Probably 2 years ago would have been 10 to 15, right? So, back to my comment about retracing, I think that's a fundamental retracing of about 3 to 4 years, probably back to where it was then. Founders look for dilution. They're trying to minimize dilution, I should say. So, 20, 25% often comes in. So it's sort of a factor of the amount of capital that you're looking for, the view that the management know what they're doing. They've obviously got experience in the particular opportunity they're looking to prosecute, and they've got some sort of validation that there's a good market opportunity, and that will help, right? But then the art comes in at that point, and it's a bit of an arm wrestle. But I think you'll find that most seed deal or pre-seed, which I think was the question, was pre-seed actually, but specifically, kind of tend to come in that sort of 5 million type range-ish. Sometimes there are outliers on that for various reasons.
Right, thank you. Another question. So to which extent is VC funding mandate aligned with government policy and direction, say, for instance, with R&D and climate tech space? Martin, probably one for you.
Look, I think there is. That's a very long question. Actually, we'll all have a view on that. I think that there is good government policy to support early stage venture capital investing, right? So at a very simple starting point, what is called an ESVCLP, early stage venture capital limited partnership, which is a structure that most early stage VCs utilise, an Australian structure, is a very tax advantage structure for its underlying investors, and that is good policy because that incentivises a flow of capital to our sector. So we like that. We like the R&D mechanisms. There are frustrations at times with the processes you have to go through, but R&D is a meaningful R&D rebates, and the R&D tax regime is a meaningful support for early stage companies and a good source of funding, non-equity dilutive, right? So we like that. We think ESOP generally and ESS early stage employee option type schemes, I think that's way too complicated in the Australian market and has been for years, and that's a constant agitation that I think industry has taken back to government, and we've seen enhancements over the years, but I don't think we've really seen that simplified to a level that we'd like to get to, and that's a work in progress. So I think there's good understanding at both in opposition and in government at the moment on the value of our sector and the benefits, the broader societal benefits of that. And there are levers that they can pull, and they're always guided by industry on that, and it moves at a pace, arguably slower than we'd like. But I do think generally there's good alignment, but it's never perfect and never will be, right? Because there's always changing circumstances. But let's maybe hear from Sarah and Dan on that too.
I might just make, sorry, Sarah, just quickly, one point though. So given I cover fintech, and a lot of kind of lending fintech businesses don't qualify to go into an ESV VCLP structure. That doesn't mean that people aren't investing in that. And what you tend to find is that most VCs will have different structures, whether it be kind of early stage, somewhat later, sometimes just private investors, sometimes quasi equities, depending on who the investor type looks like. So there are different kind of vehicles that that VCs and professional and financial sponsors work with. And the idea there is they don't want to be fully limited to not be able to go into any route. But I have been in situations where certain kind of investors have said, look, we love the idea, love the business, but it doesn't sit within this mandate, it doesn't sit within this mandate for this fund, and therefore we kind of are a bit stuck in terms of where it sits. So again, like there is kind of that mandate, and the government policy does impact it. But for the most part, parties will try and work around that, and they'll try and use creative ways to articulate a business plan to try and fit it in if they need to. So yeah, Sarah, sorry, I interrupted you.
No. I was going to make a comment perhaps on the broader policy environment actually, and direction of travel for that, and thinking about how startups sit within that, because I think it's a really good point around where government, state and federal are focusing their attention right now, and post Job Summit, but it's actually a longer play than that. And it is very much in parts of the economy and sectors where VC plays. Tech is an obvious one, but high tech manufacturing, you only have to look at what, for instance, the New South Wales state government are ploughing into their tech hub out in Western Sydney, supporting that climate transition and the technology that's actually needed to do that. That's a really big push that we know is going to come through from the federal government. It was announced with great fanfare at the Job Summit, but it's something that they are looking to deliver on. So I think the broader policy environment is actually pretty supportive for a number of the sectors and types of business that would be in this space. And then there's Martin and Dan are saying those more specifics policies that support VC activity add to that. So I think there's it feels for me as though we're going into a period where government is going to be very actively trying to push. I don't want to call it industrial policy. That's a slightly dirty term as an economist. And it's not that. They're not trying to pick winners, but they are trying to, if you like, move the playing fields at least a little bit to be more supportive and to diversify the economy in that direction, and to prepare it for a different looking future, if you like. And that, I think there's parts of that will really play to companies in this space.
Thank you. Okay, there's another question. There's been no mention of the experience of founders or the strength of experience of the team. However, this is often cited as one of the most important factors in early stage investment. Has there been any change in behaviour here?
Not sure on the context of the question. I think team's important, right? Actually, team is the most important. Let's be really clear. I will always back a team with a questionable model and a questionable market if I think the team can adapt, right? And there's more likelihood of that than backing a bad team in a great product in a great market, because they'll bugger it up, right? So to really simplistically put both ends of that spectrum, team comes first. Team comes first. So team is critical. And team is something we look at really closely, you know, and you know, understanding the psychology and the background and the expectations and hopes of the founders is actually really important. Startups are hard, right? And there's a lot of you on this call, and it's hard. I get it. I've been there. And you've got to have amazing resilience to work through, because it doesn't all go to plan, as we all know, right? To use the great phrase, shit happens, and it happens a lot. And it's unexpected, and you've got to manage through. So we do look at that really closely, and you know, the team factor in our analysis is almost top of that priority of assessment. Have you got what it takes to take a journey that's usually longer than you think, right? So everyone thinks I'll IPO in 3 years. You won't. Pretty well guaranteed. It might be the odd exception, but you know, we do see that on decks a lot. Don't put that in decks, by the way. It's a bad signal that we're going to IPO in 2 years. No, you won't. So you know, we see people's expectations on timeline are much tighter than what the reality is. It's a bit of a slog, but you know, the rewards are terrific for those who work their way through. And we really look for that sort of resilience where we can measure that and get a feeling for that.
How do you do that? Sorry, how
look, talk, right? No other way, right? And background, you know, you talk to previous people that they've worked for or with, or other, you know, other businesses. You know, second-time founders, is there a correlation? Second-time founders have a higher return outcome than first-time founders. I think there's various data sets around that suggest that is true. You know, my sense would be it would be, because they've kind of been there before and they understand. You know, they've learned, right? I mean, we're all learning. Every day is learning. So founders who have been in circumstances before, work their way through it and come back again, generally a better second time around, I would think. I don't know, Dan, Sarah, any sort of perspectives on that?
You're right on the statistics. I've had a look at those, and statistically it is true. And I think you're probably right on the reasons why. I mean, you know, taking my economist hat off and just thinking as a person, if you've done it once and you've overcome all those problems, and you're willing to have another go at it too, like you want to have another go, that's probably means you're going to at least know the effort and be willing to put it in, which feels like half the battle from listening to you guys.
Yeah, and I think more than that, like there's definitely an element, especially at kind of seed stage, if someone's done it successfully in the past, that already gives you kind of a step up on someone who's kind of maybe a bit younger, maybe a bit more inexperienced, or hasn't had the success. I think you're right, Martin. Like when we do our due diligence before kind of working with a client, because we take on risk, because a lot of our fees, for example, are success based, we'll go and speak to the market, understand who knows that person, understands how they are, and that's not just about performance. It's around culture. It's around how they treat people, whether they're someone you want to work with, because as an investor, it is a partnership, right? You're aligned at an equity level, but you do need that person to be able to execute in a way that you're comfortable, and ultimately your LPs are comfortable to execute as well. So yeah, I do think that's the most important thing, especially at very early stage, as you start to become more evolved and more mature and move from kind of that startup to scale up, even to kind of the growth and maturity stage. The business starts to speak for itself, and the numbers can kind of be, you get a bit more science associated with the numbers. But the amount of kind of deals that I've kind of worked on, which I hear about, which have fallen away because there's been kind of bad sentiment around a founder, or there's kind of a view that they're not someone that they can work with. It's really important. So yeah, always do the one thing I always say to people: kind of treat people how you want to be treated. And there is kind of, everyone talks about karma, but karma from years before, it kind of comes back. Your profile and your brand is what kind of sells you at a level, and doing the right thing kind of throughout that journey kind of really does pay dividends later down the line.
Okay, probably one last question just came in. I'd be interested to hear from all of the panelists as to their view on how statistics will show for female founders in the next 3 years compared to the current statistics. Wow, that's a hard one. Well,
I'm not sure what statistics are being referred to.
I know.
I think direction of travel, to use the phrase Sarah used earlier on. Yeah, you know, we're seeing we're seeing a lot more female founder-led businesses. We're not measuring against that. You know, I don't set diversity targets at the portfolio level. But you know, there are, you know, incredible founders, male, female, otherwise, you know, that are doing great things. We look at that, and we're just seeing a lot more female founders, so we will inevitably back a lot more female founder-led businesses. And I think that's characteristic across the whole Australian market right now, is that trend's certainly occurring. Don't know, Sarah, you might have some statistics that might validate that.
Yeah, I think one actually just popped into the chat that while it is growing, it's still very much founders tend to be men. The vast majority do tend to be men. And I was actually just reflecting on the comments. The previous point we were making around second time around, you've perhaps got a bit of track record, so you're easier to back. There's some evidence there, and that can be very difficult then if you're a woman, because typically you won't be a second time founder. I think it's interesting, again, to go back actually to the government policy. There is so much action and focus in this space, specific funds from government that are targeted at women to help them overcome this. And perhaps this is something that Dan and others that help bring companies to market can really help women overcome, is how do you show that credibility that you can actually succeed. I do think that it will grow because there is a move in that direction. There are these specific supports which are going to help with that. But yeah, when you're starting from the stat was 3%. If you're starting from there, clearly it's an awful long way from 50-50. That's, you're not going to get there in 3 years. But I mean, I guess speaking as a woman, I very much hope that we can go in that direction. There's no reason women can't run startups, as Martin was saying. So it's about getting them into the game, and people like Dan can help with that.
Yeah, and I think more than that, what we are finding is that kind of investors are expecting kind of leadership teams and boards to be representative, not just of gender split, but actually diversity across the board now, and that's becoming far more prevalent. So, and we're even seeing kind of specific funds set up. I think Justin Ryan, who was one of the senior partners at Quadrant, recently kind of went and set up with Kate Morris, the founder of Adore Beauty, a fund dedicated to female founders. We've seen success of obviously Kate, but also the founder, for example, Modi Body and other businesses. So success breeds success. The challenge is it does take kind of a long time to see this flow through, when women go onto leadership boards and then they get the power and the ability to then kind of set up their own initiatives. That's kind of a long process to kind of start, get money in, exit, and see that success. But definitely, I think that 3% number will only rise. I can't believe that's where it will stick. And there's a very strong push at all levels, corporate levels, kind of VC levels, investor levels, for there to see more diversity and more female representation across the market. In fact.
Yeah, absolutely. And on that note, I think we'll have to finish up. So I just want to thank Dan, Sarah, and Martin for your insights. That was fantastic, super helpful. And also just a reminder, this is the first in a 4-part series that we're running. So it's each Wednesday morning at 8:30. Next week is Conserving Capital and Runway. So we've got Rachel Newman from Flying Fox, Robin Langsford from KPMG, and Charlie Wood from Wise talking about that. So that'll be a great one. We actually sort of delve a little bit more into some of the topics we talked about, we covered today. So I have 1 minute to go, right on time. Thank you, everyone. And thanks, panelists, again. See you. Bye.
Bye-bye.